Question and a 15-minute Q&A session at the end. Please feel free to drop your comments as we progress through the session. Right. Let me start by introducing our panelists. Jon Naseath is the CFO and founder at Cantu Capital Inc. As a CFO and with a background in AI and machine learning innovations at Google, Jon excels in delivering solutions that address social and economic needs. Welcome, Jon.
Thank you.
Next, we have Dave Sackett, who is a VP of Finance for Persimmon Technologies, a fintech speaker and Forbes writer. He shares insights on AI, blockchain, and e-commerce. He's committed to a lifelong learning and kindness. Dave also co-founded AIOne to boost e-commerce sales. Hi, Dave. Great to have you. And lastly, we have Rajiv Pathak, who is the CEO and co-founder at Hyperbots Inc. With over 30 years of experience in building technology products and businesses for global markets. Rajiv has managed the technology business for Wipro as GM and vertical head, handling a business of over $100 million. Welcome, everyone. Good morning, Jon and Dave, and good evening, Rajiv. Hello, everyone in the audience. In the next hour, we will discover how Agentic AI can play a huge role in detecting and preventing fraud and anomalies in finance and accounting. We will organize our discussion in 3 sections. In the first section, we will discuss real-world frauds and why traditional defenses fall short. Right? In section 2, we will cover how Agentic AI detects, decides, and prevents fraud and anomalies in real time. And in the third section, we will discuss practical tips for integrating Agentic AI into finance workflows. We will close the section with enough time for questions and comments. So let's dive into it. Jon, my first question is to you. At a high level, what are the 5 costliest fraud or anomaly types across the finance landscape today?
First, Deepak, thank you for the introduction and the opportunity to be here.
Sure.
Really, the most impactful and costliest is the key variable, because a lot of times a lot of different fraud things can make it in the news. And from my experience, as I'm a certified fraud examiner and have pursued these things for a long time, oftentimes the things that make it in the news aren't the most costliest. That's the thing I wanted to call out here. And there's oftentimes some big dollar things that companies don't want in the headlines, the news articles about what may have happened. So, but overall, from a true costliest perspective, I'd say vendor payment fraud, fake or inflated invoices, those flow through all the time. A lot of us have heard in the United States how that was happening with the government. And actually I saw something this morning, it was just this week or yesterday, that they actually are now finally doing what I would call normal vendor payment authorization things in the federal government. That wasn't a political statement, just an observation. Revenue leakage, order to cash. I built a whole practice at KPMG around that topic. A lot of my friends are still doing it. Hidden discount abuse, business email compromise. I'll tell a story about that another time. And then indirect tax carousel schemes, picking the wrong tax code, and kind of, some will debate whether that's fraud or just whatever, but it's fraud if you're doing it intentionally, and if you're not doing it well, that's definitely straight up fraud. And then FP&A model manipulation. I remember working as an accountant. There's a difference between accounting and FP&A and some of the art that goes into FP&A and how you tell the stories, but you do that wrong to the investors, that's fraud. So those happen, all those happen often, and there's great debates and lawsuits happen if you do FP&A fraud manipulation to your investors. So those are my top 5.
Very interesting. Thank you, Jon. Moving on, Rajiv, staying with P2P for a moment, what makes mid-market companies a soft target for duplicate payment or overbilling scams?
So I think, first of all, good morning. Can you hear me, Deepak?
Yes.
Deepak, can you hear me?
Okay. We can hear you.
Yeah. So as Jon was telling, that vendor payment fraud, he kind of a little bit talked about, but I would elaborate that a bit. Usually mid-market finance teams are very lean. So if you take, let's say, P2P or account payable, few people must be managing hundreds of vendors. they kind of manage thousands of invoices, so they are short of bandwidth. And if the processes are human driven, so just take the example of onboarding vendors. The vendor information moves from one place to another place through email in form of Excel, and that is a very simple sort of resource to get exploited for fraud, right? Vendor accounts could be manipulated while file is moving from one place to another place through emails. There is a probability somebody could hack it, modify it on runtime, and when the receiver receives it, he gets a different information, right? One could manipulate the the vendor invoice and send something else by changing just few fields, and it may look like a true invoice. So there are in absence of significant human oversight in these manual transactions, there is a scope of risk virtually at every place in this processing pipeline. So therefore, until there is some deep, automated, robust, secured, processing of entire pipeline, I would say it's highly vulnerable, place for any fraud to happen.
Got it. Got it. Thanks, Rajiv, for that. Dave, the next question is for you. In O2C, why do rules-based receivable systems miss revenue leakage and fictitious credit memo fraud? Can you shed some light on that?
Yes, yeah, thanks, Deepak. For order to cash, you could have some sales orders that are putting miscellaneous revenue into the future, kind of outside the current scope of what gets audited by a staff. You've got credit memos that could be put on fraudulently, and you could backdate them so that it goes out of the really current period focus into the future. And another thing fraudsters will do is put in small credit memos, things that may fall below a materiality threshold, trying to evade detection. And if that works, then they get bolder and bolder and continue that fraud.
Understood. Understood. John, Treasury is a hot target, right? And so can you share a case where traditional bank portal approvals still fail?
Portal approval. I got a good story that aligns with this, and unfortunately, a lot of companies have good stories about this now. So I'll share mine, and we'll see if anyone can commiserate. I had just signed up and gotten a loan approved with a private lender, and we got the money, and it was very clear, I was going to manage that loan and pay it off. Everything was fine. And then I got a call on Friday night. This was, let's just say, a while ago. I don't want to name any names or any companies, but I got a call on Friday night from someone saying, okay, this is the final call for underwriting. We just want to approve your loan and just get your approval verbal so that we can send you the money. And I had already gotten the money from the lender. And so I was like, no, what is this? And it turned into this, found out it was a different someone, and they were spoofing, and they wanted my record me saying it was okay so they could. And then when I said no, they're like, it's too late. We're already sending the money. We already have the signed documents from your CEO. This was just a courtesy call, and thought you'd like to have more money. And I was like, no, because I knew it would actually put me at breach of my previous loan. So come to find out. And then later I called up my CEO and I was like, what is this? He said he had your signed signature, and he actually did, it turned out. Because what had happened is, it was like a year and a half ago. They had called my CEO. Someone had called me up and said, and I had just said, hello, this is John. That's all I said. And then it was silence and I hung up. So never say even if it's silent. And then they called my CEO, spoofed my voice with AI, and it sounded somewhat like me, and convinced my CEO that he was supposed to sign this document for a contract for a new loan. Have a keyword for key things like that. And so now after that, we always had a keyword of how we know that it's really him if I'm really asking him to sign something or do something. But that was a very heated experience, and we were able to resolve it.
Pretty sinister. Right. Moving on, Rajiv, what tax-related anomalies slip past standard ERP tax engines?
So ERP tax engines, for example, let's take the case of sales tax. They validate sales tax based on tax dictionary, but they cannot determine the context. So, for example, let's say there is a exemption certificate which is provided by vendor, and it has become outdated. Now, until there is an intelligent agent that is doing, regular check on vendor exemption certificates, there is a very high, probability that vendor continues to sort of not charge any sales tax with an assumption that he has sent exemption certificate which is valid. So you could deliberately do, or it could be by ignorance. But the point is, if he has moved out of tax exemption, regime, then there is a tax liability, which leads to penalty both for vendors and for company, right? So therefore, there is a huge implication of this, right? Similarly, there is a chance for fraudsters to sort of even manipulate domestic invoices as export invoices, right? And treat them as zero tax invoices. So there is a liability implication which could result into huge penalties. So I mean, unless either physical verification of all tax being charged and the corresponding exemptions and overall tax management is very robust, it's again a vulnerable area in my view. Yeah.
Understood. Thanks, Rajiv, for that. Dave, what does FP&A anomaly look like in practice? Do you want to,
So from an
touch upon?
FP&A, yeah, from an FP&A point of view, you could give positive news in a future forecast in an FP&A model, like dropping churn from 6 to 3%. That FP&A model doesn't get audited. It doesn't have the right attention at the right time. So having that good news could tell Wall Street, hey, things are getting better for this company. But in fact, there's nothing backing it up. It's just hidden in that model.
Got it. Great. Turning to Jon. Jon, one subtle signal, can you talk about that screams anomaly, yet rarely hits a classic exception report?
I'd say
yeah, go on.
watching for anomalies with if there's someone's asking for an approval between like late at night and early in the morning, kind of just in their not at their normal cadence of when they would respond to things, especially if it's a big ticket, say wire or something, that could set off some concerns.
Understood.
Or actually, if you haven't talked about it before, I'd give that one. Like, if this is suddenly send this big wire, and in our roles, if it was something like that, we would have talked, and then before they just call up to tell you to send the money. I'm not sending money unless we've got a plan.
Got it. Right. Okay. So moving on, we will now sort of touch upon how agentic AI detects. Like, we bring in the agentic AI aspect into the discussion, how it detects, decides, and prevents fraud in real time. So my question to Dave, what fundamentally separates an agentic model from a standard predictive model?
So say your standard predictive model is based on math and certain drivers that spits out a probability. At that point, a human gets involved to close the loop. With agentic AI, the agent actually owns a closed loop, meaning it can use policy. It can be based on, you can make decisions based on policy that can not only figure out what's right and what's wrong, but then take action. So you have to follow a policy, you take action, and you can prevent that action in real time using agentic AI. It's very much goes, policy bound. It doesn't do its own, it's still within the bounds of what it's supposed to do. and it more acts kind of like a junior accountant or financial analyst, executing based on all the inputs that it sees.
Got it.
Can I jump in on that one a little bit?
Sure. Go
I
on,
like
Jon.
what you just described there about like a junior accountant, or like I sometimes refer to agents, AI agents, as like a college intern you hire, and sometimes you get good value. The trick is I found by, especially with financial analysis or fraud type of things, stacking them together. And there's ways to combine what one agent versus another agent together in the right specific role, tied together, makes a more powerful output, is my observation.
Yeah, thanks for that addition.
All right. So moving on, next question, Rajiv. Do you want to illustrate the loop for a P2P invoice fraud scenario? Can you elaborate on that?
I think this is idea, and this action is all about AI agents and how they can prevent fraud in real time. So now let's take the case of P2P, right? Now let's take a simple case of invoice processing. If there is a agent which is reading invoice emails in a highly policy-driven, rigorous manner, first of all, it will eliminate the fraud by ignoring the emails from the vendors which are not listed. Very robust check of duplication of invoices. Any manipulation of invoices which is done can also be cross-checked, right, during this document processing, right? And even if it is through this agent, if you have another agent, let's say matching agent, which pulls out the purchase order and goods receipt note from ERP and does two-way and three-way matching automatically, right? Now this agent, which is a matching agent, is comparing the incoming information in the invoice compared to the ground truth that exists in ERP, and if there is any probability of any manipulation that get caught during matching automatically by this agent, right? So if you design robust agent in invoice processing pipeline doing tasks like email reading up to matching and GL coding and posting, I think chances become close to zero for fraud or any anomaly to slip through into your books.
Understood. Dave, any O2C example?
Yeah, in order to cash, you may have a fake credit memo get created. And what Agentic AI will do is look at the warehouse management system and see, did a shipment and return actually happen? That'll be one check that happens, and then compare that against the ledger. And if it detects that, hey, wait a second, this credit memo is not based on anything. There's no RMA, return material authorization, and it's not going to put it through. So because the AI can detect, hey, there's a problem, now it can take action and say, okay, stop. We're not processing this. It's been detected. It's fraud, or at least we suspect it's fraud based on the policy and based on all the data inputs that it's getting to prevent it from becoming fraud in real time.
Understood. Jon, tax anomalies often live in both AP and AR. How do agents talk across these silos? Can you talk about that?
Yeah. Well, one thing to also acknowledge is it's now April in the US. April is tax month, at least for a lot of personal taxes. So maybe people don't want to remember what they might have submitted. I'm sorry, bad joke. But I'll talk about taxes a little bit with AP and AR. So yeah, it can be at either side. And really, I mean, the intent here is anything that's just inaccurate submissions and anything that is beyond the threshold of what you'll define as acceptable. The way that AI can get into that is if you think about polishing or submitting different anomaly events, like a vendor, a tax code, a risk score that's just not accurate. And there are situations where you could submit an event that you see into a vector database or something that's shared that others will be looking at, and it's not accurate, but it kind of justifies what you did. And then if another tax agent or someone else is relying on that information, that could become problematic. So the simplest way of saying it is just if you're using, like, I think about if companies use like TurboTax or something, and you're submitting inaccurate assumptions or triggers into that and saying that's how you're doing it, that can feed into it and cause impact for other people, because the AI might view that as acceptable, but it really wasn't.
Understood. Got it. Yeah. So I think moving on, Dave, FP&A models aren't transactional. So how do agents monitor them? And I think this would be one of the last questions on this section before we move on.
Sure. So with FP&A models, there can be a comparison step that Agentic AI does. So it can look, and in the example I talked about earlier, where a fraudster changes the churn rate from 6 to 3%, there can be that flux analysis comparison between models. So whether it's in Excel or other software, it can make that check and balance to say, hey, wait a second, you changed something. It was this, now it's this, and you don't have a policy for it. There's no backup for it. I can't find anything. That's a problem. So that's where it's a solution to what I was talking about earlier, by comparing those FP&A models that aren't traditionally audited. But you could have your agentic AI do that for you.
Got it. Anything to add before we move on to the next section, which is about practical tips?
You may want to check. I think maybe audience, if they have any questions,
right,
free to ask them. We could take in middle of the discussion as well, right? Yeah.
Sure. Yes. Yes. I don't see any questions at this point, but yeah, I'll encourage the audience to, drop your questions in the comments as we go along. All right. So let's move on. So the next section is about practical tips for integrating Agentic AI into finance workflows, and it'll purely focus on hands-on guidance for rolling out fraud or anomaly agents across P2P, O2C, treasury, tax, and FP&A. Right. So, John, my first question in this section to you: what data hygiene steps are non-negotiable before any pilot? Right?
Yeah, I just keep seeing this over and over again wherever I go. You really got to get the customer master data clean. Like, that's the key starting point, or vendor data or customer data or your IDs clean across data. The biggest way that you can run into trouble is if your databases aren't able to talk to each other and aren't able to compare the data together. Again, not just calling out some of the stuff we've seen from the federal government and people taking advantage of Social Security databases and not talking to healthcare benefit databases, and getting clean master data is pretty basic things. Also, to the degree you can afford it in the system, turn on audit trail logging. That's always a balance, because the auditor will say turn it on everywhere, but then that starts costing. So you got to figure out where there's risk and where you need it.
Got it. Dave, quick wins. Where should companies place their first agent and why?
Yeah, it sounds obvious, but really where the pain is. Where are you seeing the biggest issues? Where are you seeing people spending lots of time to try to detect fraud, to try to detect anomalies? Set that up as your target to really address with agentic AI, and hopefully with that you can create a return on investment on that based on things that have high volume of transactions and high pain points for the department.
Okay. Rajiv, how do you frame the project so AP clerks, AR analysts, and treasurers embrace agents instead of fearing them? Any pointers?
So I will come to this, but again, just to add on to what Dave told on the previous point that you were asking, which is where should companies place their first agent and why? So while there are two elements to this, right? One is in the context of overall ROI, where ROI makes sense. But from fraud and risk perspective, if that is the objective, then in my view, further to what Dave said, the ROI has to be from the perspective of detecting and prevention of that fraud, right? So what has been, for example, historical risk areas for you, right? Even though purely from financial return on investment perspective, on cost side, cost takeout side, and all that, those tasks may not be, very cost ROI amenable. But from risk prevention perspective, there are some tasks in finance and accounting which are uh, which have very high ROI, right? So my sort of take on this is it has to be a combination of your cost ROI and other tangible, ROI that you see. You combine it with the risk prevention or fraud prevention, assessment as to which areas that adds a lot of value, and then decide as to which are the set of agents that that one should deploy, right? So for example, if historically, if your account payable function is having a lot of tax penalties and liabilities, right? you know Even though you do not have a lot of people working, human effort on the tax compliance in the company is low, and therefore deploying agents not necessarily will do a lot of cost takeout. But if you deploy good AI agents on the automated tax verification, the prevention of the anomaly, either deliberate or non-deliberate, can save thousands of dollars of tax penalty. So therefore, employing a tax verification agent should be a high priority for you compared to any other task, and vice versa. I mean, there is another scenario wherein you could have a task wherein, hey, your risk is obviously not very high, but I have very significant team working on invoice processing, and therefore for me the cost takeout is a bigger ROI. So you could decide that way. So my 2 cents here is that it has to be a very conscious decision of your risk prevention ROI and your cost takeout ROI, that you have to balance and decide which agent is the right agent for you to adopt first. Yeah. Now coming back to your next question, which was about. Can you repeat the question, Deepak?
Yeah. How do you frame the project? So AP clerks, AR analysts, and treasurers embrace agents instead of fearing them, basically.
So see, there are nobody in the company, you know, prefers the risk or the frauds to exist, right? So if your positioning of AI agent, one of the positioning of your AI agent is that they will prevent anomaly, they will prevent fraud, or they will detect fraud, everybody eh, will be for it, right? So that is one side of it. So I think that is a no-brainer that everyone will like the positioning of AI agent, to be some sort of guarding, clerks or guarding agents to prevent frauds and so on and so forth, right? So that must be positioned. The second one is purely from the perspective of other tangible benefit. I think this would be positioned more as a productivity enhancer than they being the replacement agents. So if you position, for example, I come back to this P2P examples. If you position, um, let's say, month end book closing agent or accrual agent as an agent which will help you close books 5 times faster, the acceptance of that accrual agent is going to be very high, right? Similarly, for example, if you position invoice processing agent as an agent to a clerk, that now currently you process whatever 100 invoice a day, right? Now with help of this AI agent, you can process 500 invoice a day. Then the clerk suddenly feels more empowered, feels more productive, and feels more valuable, for his organization. So it's all about positioning. In my view, the risk side, fraud prevention side, if you position it, communicate it well, everyone is for it. There is no dispute about it. On the tangible benefits, on financial ROI, side, position it as a productivity enhancer. Then I see no reason as to why, AP clerks or for that matter any other humans working in finance and accounting processes processes should dislike AI agents. Yeah.
Can I jump in on that one also? I think it segues to the next topics. I was at KPMG for 6 years, and after doing normal SOX and audit stuff, I helped build a practice there called Contract Compliance Services, and then some other people have gone into different other businesses from our team that stemmed out. But the basic concept was this: there were bad things that are happening in big companies, and bringing in professionals who can figure it out, the facts, and sort out how to resolve it and identify the tangible benefits without trying to prove intent, without trying to prove it was fraud and bring lawyers in and do all the bad stuff that can happen. So these are situations where that probably might have been happening, and there could be bad threat of things happening, but almost as a way of saving the relationship and resolving the situation, you can come in and address it. And I jumped in there because I've seen that throughout my career now, that there's opportunities. I mean, you got to watch for the red flags of fraud, and if it's fraud, you got to beat it down, and you need to hold people accountable, because they'll just keep doing bad stuff. So I definitely believe in prosecuting fraud. But if it's not clear, there's so much value to the business in using AI, using analytics to triage and find anomalies, using fraud prevention techniques to solve business problems can be its own solution, as opposed to, I like to turn the discussion around. Rather than saying, let me justify the fraud stuff, the fraud prevention. No, let's use the same techniques to justify the business value and get the business value. And the fraud prevention is a nice byproduct. And there's plenty of value from just doing these good things that I believe justify the cost.
Absolutely.
Actually, yeah, I just want to jump in on that. The auditors are going to use Agentic AI to compare your data. They're going to be looking for anomalies, looking for fraud. From a company point of view, I want to make sure my data is clean. I want to make sure that I don't have anomalies that I don't know about. So I would want it to, almost like in defense, to say, hey, wait a second, if anything's going to pop out to an auditor, I want it to pop out to me first, as someone who's managing our numbers, to make sure that we pass the tests. And if there's something strange, I can look into it as the company and not have an auditor tell me we've got an anomaly in our data.
Right.
Correct.
Most frauds historically are not found because you found it. It's found because some whistleblower told you about it. And so I'm always nervous when I hear about that. Like, okay, then what are we not uncovering? Like, what's not there? And so that's my experience technique also, is let's use data to proactively find the crap. Sorry, find whatever it is that's going on, and not wait for the whistleblowers or the auditors.
Right. Yeah, I think that's an insightful take on. So the next question is around governance and documentation, and how regulators, what kind of documentation will keep regulators and auditors comfortable when they know there are agents that are taking autonomous actions. Yeah.
I like the question, but I just want to poke back a little bit. The idea that if I get enough data, I'm going to get my auditors and regulators comfortable.
Right.
From the auditors and regulators that I've worked with, they're never comfortable by definition. And it's more a matter of, and if you ask them, how much do you need to do to get comfortable? They'll never stop telling you to do more and more and more. So again, kind of going back to what we were just saying, I like what Dave called out. I want to get enough data and enough insights and use AI to get me comfortable and to get my company proactively using insights to manage our potential risk of fraud and our anomalies and all the things. And the auditor is going to be happy with whatever I am doing for my company. I'm not making business decisions based on what the auditor is saying that or the regulator is saying they need. My threshold should be higher than theirs actually, but and if they say they're not happy, I'm going to tell them, I'm sorry, but this is what we're doing. That's my way of managing auditors and regulators, per my approach. The types of things that get me comfortable is, I want to see that if there's changes that are being made, I have a kind of a history record. I know that an audit trail is kind of the key thing that I can tie it back. especially with AI, when I start having an agent making changes in the system, I want to know that we're doing hashes with the data and I can trace things back and do it. I don't ever want to wake up in the morning and not be able to know how this, because it's scary, right? When your data gets bad or there's an error that happens in the data and you don't know what and how, you can't reverse out and do the audit trail, you almost need to abandon all that data set or it can take a lot to get comfortable. Understanding the risk score on it, getting snapshots is how you present some of that. Identifying who made changes and how to unwind those. All these sorts of are things that, again, sorry to pick on you, but to push back on the question. But yes, I think we need those for ourselves in our own roles. And if you're relying on an auditor to be happy, you'll be waiting a long time.
Actually, I can jump on that. Making auditors happy. So when it comes to AI, they don't want to just say this agentic AI took care of it all, no problem. They want to know, well, what rules does it have? What policies does it have? What access does it have? What systems are being affected by agentic AI? So instead of kind of being a black box, you really kind of say, here's exactly how it's supposed to work and now you can audit what we just told you agentic AI works. So that would
I feel like I should not apologize, but acknowledge I'm a CPA. I spent 6 years auditing. I'm certified fraud examiner. So I say it with love to my auditors out there listening. Yeah. If you want to be happy auditors, go to the beach and enjoy your life. Don't wait for companies to get happy.
Yes, that's a good disclaimer. All right, moving on. Dave, on architecture, embedded in each system or orchestrated externally? What's the take on it?
Yeah, with agentic AI, you can have external orchestration, meaning it can tie into external databases without manipulating those databases. It can read them all, and then from that, it can act and decide. So you've got, this agentic AI with so much more capability that can do all these different processing steps to lead from, reading information to making decisions to then taking action. And it can be Excel.
Right, and I would add here, Dave,
yeah, go ahead, Rajiv.
I completely agree with you.
Bit of a lag there, so yeah,
Okay.
Rajiv.
We heard that he agrees with you, so we'll take that as a win.
I'll take that as a win.
Oh, he's back.
Yeah,
we lost you for a second there, Rajiv.
Okay, no worries. So I was talking about, I agree with Dave. Essentially, the advantage of AI agents is that it can talk to disintegrated systems, can establish correlationships of data, correlationships among various systems and associated data, identify anomalies and patterns across systems, right? Which is very complex and difficult for humans to do if data sources are very large, and if one has to wait just for audit to catch anomalies and frauds, it's too late in the game. Wherein agents can prevent it or detect it in real time and make sure that some big anomaly do not happen, right? So that's the way I would say can be really big impact of agents in making sure that the systems are secured and the anomalies are prevented.
Anything to add, John, before we move on?
I jumped in enough.
All right. All right. So next one is for you, John, about KPIs. So which KPIs prove valuable at month 1, month 3, and month 12?
KPIs in the space of fraud detection can be a difficult thing because you kind of always get this pushback from executives. Well, how are you measuring? How are you showing your value? And the answer wants to be, well, here's how much money I saved. Here's how much fraud I prevented. That would be the ideal KPI. But a lot of times prevention is the best measure. So it can be difficult to get real numbers. My point is there are indirect value, and it's worth acknowledging that indirect value, because even if there is not direct, oh, I found this and saved it, that might be okay. that you didn't find any because you had the prevention. The ideas of the metrics is how many detected, how much money saved, false positives that you found and were able to prevent. I want to give one more quick story on this as an example. I'm trying to throw some fun stories in. A friend of mine works for a large financial technology company where, if they had any KPI, we found any fraud, their whole company would lose trust and he would lose his job and it'd be very bad. So for their KPI, it's expected 0. Like that's the metric. As an example, though, one of the I thought pretty fun tools they use, sounded pretty aggressive, is their company, he sends out spoofing emails, like phishing emails to their own internal people, trying to get them to click on links that take them to false locations. And they're pretty sneaky about the types of things that they'll send and get people to click on links. And like if you click on one, the message is you click on one, just click on it, just to even look at it. You don't even have to like enter information. If you click on one, it's like performance negative. And if it can quickly go to a PIP and it's very bad for their job there. So on the flip side, it's reached a point where employees aren't clicking on any emails. Internal HR sends out something saying, hey, we're having this event. Click here to see the menu of the food. No one will click on anything because they don't want to get on a performance hit. So I guess my point is finding the right metric depends on your environment, and it's difficult to find the right metric. Watch for risks. 0 might be an okay number as far as a KPI. You didn't find any, but you prevented it. And be creative is what I throw out as the last point.
Understood. Right.
Yeah.
Dave, Rajiv, you had anything to add?
No, I think another way to look at it is that
Oh man, a bit patchy, I think, Rajiv's network. So, all right, yeah, we can hear you now. Rajiv, go on.
Yeah, we can have different KPIs in different organizations on fraud prevention. I think that's the point I was saying. Yeah.
Understood. Okay, moving on quickly. Dave, how do you keep false negatives, missed frauds under control while the system learns? How do you do that?
Yeah. So my approach would be trial and error. So you don't want your tool to be so tight that it's now taking so much time to get rid of these false negatives. So you have to really balance, your internal resources with the tool, and to train the tool. During that, you're going to spend more time as it learns, but then you're training it to get better and better so that you get fewer and fewer false positives. So it's balancing training the model versus managing the model.
Got it. We're 45 minutes into the discussion. We have one final question for Rajiv, and then we'll open it up for questions. Yeah. So Rajiv, final thought: what new skills should finance teams cultivate as agents handle 80% of routine reviews? Okay. As we wait for Rajiv to be back, maybe we can. Rajiv, did you get the question? Do you want me to repeat it?
It's fine. I'm sorry. I'm in a very patchy area. So I think the question I believe you were asking is that what new skills finance team should have in this agentic, AI scenario. Correct?
That's right. Yeah.
So I think the ability to handle exceptions, right, and ability to start monitoring technology-driven output and start trusting once you start seeing the positivity of that output is what are the key skills, right? And using data for what you say collaboration, negotiation is another key skill that teams should have, right? The teams have to move ahead compared to old paradigm wherein they were doing a lot of things manually. They were using systems which were rule-based. Now they have to start using systems which are AI-based. So they should be able to figure it out where they need more monitoring where they can trust system fully. So that itself is a big skill. It's like you have few kids at your home, right?
Okay.
So I think it's very patchy, Deepak. Sorry about it. But I was
Yeah,
saying,
no worries. Yeah, go on.
yeah, it's essentially about deciding where to give independence and where to be, monitoring moderately, and where you need to monitor very deeply. That is the skill, and that is the sense that the individuals who are monitoring AI agents should develop, in addition to formulating policy and things like that. That would be my answer to your question in terms of the key skills and processes that teams needs to put for this. Yeah.
Great. Yeah, that's a great insight. So yeah, we are at the end of the questions that we had for the discussion. We'll move on to some of the questions that attendees have shared. So maybe we'll start from the first one here. How does agentic AI detect fraud patterns that traditional systems miss? Right? Anyone wants to take that one?
Yeah, I can try that one. So traditionally, you've got internal controls. You've got people looking at things. People that commit this kind of fraud can take advantage of that, and they can make transactions appear to be legitimate, and they can try to put them, get underneath thresholds so that they're small transactions that get through, or they imitate what's already in a database to make it look to the average person like it's a really legitimate transaction. They could give the right customer, the right PO, using the real data to make fake data. And having a human kind of look at that might get tricked, whereas an AI can be really rules-based and verification. It's that verification step of that data that doesn't get picked up by traditional methods.
Got it. All right, moving to the next one. Next question is, which data sources are most critical for effective financial fraud detection with Agentic AI?
The one that has the fraud in it. Like, I don't mean that flippantly. I mean it as a lot of times you got to look across. The fraudsters are going to try to find the one you're not looking at. And so you got to be monitoring at a summary level, and then you can dive deep into the ones that are the more problematic areas. One of the nice things about fraud is there's this fraud triangle, and there's decision trees, and you can, there's ways to study. There's only so many different ways to actually commit fraud. Like conceptually, that they, on a financial statement in a business, there's only so many ways, and there's different variations of those ways. So there could be unlimited variations, but there's still only so many ways. And you can study and identify what those are, and then watch for them and dig into the data for the ones that are triggering something is off there. Now let's go figure out how they're doing it.
Got it. Anyone wants to add to that before we move on?
Any data that is coming from outside requires higher attention. Will be my comment. Yeah.
Got it.
And I'm going to say, fraudsters and criminals are going after the cash. So how do they get paid fastest with fraud is where the attention should be.
Can I just give a shout out on that? Thanks, Dave. That's a great call out. There's like the situation where someone at your work gets in a tight situation and they make a bad choice, right? And that can be fraud. And then there's the people who you don't know that they were like these petty criminals, and they try to steal some money because they had an opportunity to steal it. So they do, and frankly, I feel that's kind of shame on the company for allowing that environment where they could be put in that pit situation. But I want to call out, there are rings of criminals whose whole thing is to find and attack you and steal from you and use fake credit cards, use fake transactions, spoof emails, all that stuff. And so this isn't just, I think one of my favorite stats with that was, they could go do all sorts of bad things that you see in the TV shows and the movies about bad things that bad people do, but they make a lot more money, and it's a lot less risky for them to attack you on some of these white collar things where they can make some of the movies I watch, they're like, oh, kill that guy for like 80 grand, 100 grand, and that's what motivating this person to go do some terrible thing in a movie. And I'm like, dude, you can get 80, 100 grand just by, like, you don't have to go kill anybody for that. Anyways, the point is, please don't look too deeply into that. But there's people who are intentionally trying to do bad things, and they will come attack you. It's not just some passive effort. We need to be ready for it.
Great response. Great answer to the question. Thanks, Jon, for the call out. I will move on to the next one. Can you share an example where Agentic AI caught fraud that rules-based systems missed? Any example that pops in your head? Anyone?
I have the term agentic AI is relatively new and hip for maybe the last, I'll say, a couple of years if I'm generous. But the idea of using data science is old school and algorithms to find things that rules-based systems missed. I can answer that one and give a good story. I was working and doing supply chain fraud prevention, fraud risk analysis, and we would look at rebates. There was a rebate program where one of the large technology companies was offering rebates for some expensive equipment. There was a piece of equipment that had been purchased and returned and claimed rebates so many times that the company that we were working with had paid more in rebates than they had gotten as revenue for that entire product. Like they had significantly more. So because groups had figured out they could just basically cheat the rebate system, and the third-party distributors who were selling product were taking advantage. And that wouldn't have been found without some multivariable algorithm looking at the data science across all the data sets and tying it together. The interesting thing is when you find it and you tell these stories, it's like, oh yeah, that's obvious. But when you're looking at this massive data sets and the company and data is moving fast, you won't find those things unless you have the right tools.
Got it. Right. Next one, I think a couple of questions now remaining. Which data sources are most critical for effective financial fraud detection with Agentic AI?
I think we already answered this, Deepak.
Oh, we did. Okay. All right. So I think, yeah, my bad. One last question then. How do you balance AI autonomy with human oversight in fraud investigations? And that's my favorite question as well. So, yeah.
Yeah, so maybe I can begin and then request Dave and Jon to add. Hope you can hear me,
Yes.
Deepak? Yeah.
Yes.
Yeah. So human oversight and combination of humans and AI agents is going to be reality actually in every process, and finance and accounting is not going to be exception, right? So now coming back to fraud detection, in my view, the humans and AI agents can act as a maker checker, right? So wherever the agents are first line of defense and are the makers or identifiers of the potential frauds or anomalies, humans must check those identified anomalies through alerts, notifications, and whatnot that come through those agents, right? And vice versa. There will be some situations wherein humans are first line of defense, wherein humans do the actual prevention and detection manually, and we can put agents to verify that what humans have identified is really the right output or not. So my 2 cents here would be that it will be a mutual maker checker model. What AI makes, humans should check. What humans make, AI should check.
That's a great response. Thanks, Rajiv, for that. And I think we are done with all the questions as well. So great. We are at the end of the session, folks, and that brings us, full circle from real-world fraud and pain points to hands-on rollout tactics. Huge thanks to you, Rajiv, Jon, and Dave, and to everyone who joined. Right. So we will email you these slides and the full Q&A log and everything, and invite you to